Hi everyone, we are now going to take a look at Chapter 2 and we're going to review the entire accounting cycle. So let's get right into it. We are going to look at every step of the accounting cycle that when you took Accounting 111 would have been Chapters 1 through 4. Now what you need to remember is that an economic event occurs that may change the financial position of the company. External events involve an exchange transaction with another entity. Internal events do not involve an exchange with another entity. Now, when we have transactions that change the economic position of the company, we need to record them and they become a part of our accounting system, right? So we start with our accounting equation. That's where we always start. Assets, which we talked about the elements of accounting back in Chapter 1. So assets are your economic resources, items you own or are owed to the company. Liabilities are claims on those assets, and so is owner's equity. Now, liabilities are the amounts the company owes to the creditors who gave them money to purchase the assets. Owner's equity is the amount owed to the owners from them providing assets to the company. So each event or transaction will have a dual effect on the accounting equation, meaning at least two items have to be affected by one transaction because it is an equation that must equal. Further, and this is what we'll be doing in Accounting 211, is working with corporations. What you need to remember is that corporations call their owner's equity stockholders' equity. There are two major parts of stockholders' equity. The part we call paid-in capital. Paid-in capital is where we keep track of the amount the company receives when they sell shares of stock. So the only time normally that the company receives anything is when they first sell a share of stock. After that, any stock sales are between people. The corporation has no financial impact from, Company A sells to stockholder 1 shares of stock. Well, in that case, Company A is impacted because they're the ones selling the stock, they'll get the money. Stockholder 1 gets the stock. Well, when stockholder 1 sells some stuff to stockholder 2, Company A is not involved in that financial transaction, so there's no impact on it. Any amounts the company receives the first time they sell shares of stock, a share of stock, because they may sell a share for the first time many years after they've opened, any amounts they received are kept track of and paid in capital. Retained earnings is where the company keeps track of the earnings that are still in the company for the shareholders. So retained earnings will be net income or net loss, which would be revenues, gains, expenses, and losses netted together, minus dividends. Dividends are the part of the earnings that are paid out to the shareholders. So dividends would decrease retained earnings. What you need to remember, and this is our life, is we do double entry accounting. So there's a dual effect that a transaction has on the accounting equation. Remember, at least two items must be affected of, the elements we talked about back in the conceptual framework in Chapter 1. Accounts are what we call the item that represent elements of the accounting equation. So each asset will have, that's an element of accounting, but each asset will have its own account. Each liability, each paid-in capital account, retained earnings will, each revenue, each expense, each gain, each loss will all have their own accounts. The ledger is the book we call, that's the book's title that contains all the accounts. So we group all the accounts together in a book, close the book, the title across it is General Ledger. T accounts are usually the format an account takes to track information about each of the elements of accounting. So there's our T account. Remember, debits are on the left, credits are on the right. Depending on the element, the type of account will determine which side increases, which side decreases. So there we go. So let's look at those rules again and get ourselves back in the groove if we're a little rusty. When an asset increases, we debit it. When an asset decreases, we credit it. Debits on the left, credits on the right. When a liability or shareholders' equity, specifically paid-in capital or retained earnings itself, increases, we credit those accounts. When they decrease, we debit them. Now, two rules that aren't there that we need to make ourselves aware of is that revenues will normally be kept track of in their own account. When a revenue increases, we credit it. It will only decrease normally when we are closing or resetting it to zero at the end of the year. With regard to an expense, we want to keep track of all the expenses, the various ones, and their various accounts throughout the year. So we debit it every time we have more of an expense. We usually only decrease an expense once a year when we're closing it out. So our PowerPoint hops right into completing the recording of transactions. So that's what we're going to do as well. And we'll come across those revenues and expenses and practice those rules again. Remember, here's an example. $40,000 cash was borrowed from a bank and a note payable was signed. Now, normally we start with a journal entry, but just because we're working with the accounting equation here, under the assets, we will have a cash account. Remember, when cash increases in the company, you must debit it. Why did the company get cash? Said that backwards, sorry. Because they borrowed money. So if they borrow money, their liabilities increase because they owe that back, so they will credit the liability, notes payable. Notice, cash increased and so did notes payable. So please don't get into a system of saying, well, if something increases, something decreases. No, that's not the case. You have to look at it and analyze it for what it is. So again, here's our accounting equation, and there's our debit and credit rules. Assets increase on the debit side, decrease on the credit side. Liabilities are the opposite. They increase on the credit side, decrease on the debit side. Paid-in capital and retained earnings have the same rules, but take a look. There's our revenues and gains. They increase on the credit side. Expenses, losses, and if we keep track of dividends in their own separate account, are debited when they increase or there's more of them. And really, for revenues and gains, expenses, losses, and dividends, we're always focused on increasing those accounts because we want to know the total revenues for a time period, the total gains, and the total expenses, total losses, and total dividends. So normally, those types of transactions will increase revenues, gains, expenses, losses, or dividends. Now, a general ledger, that first book, serves as a control account. But what you have to remember also is that, and if you've ever thought about it, we keep track of all the amounts in accounts receivables that are owed to us from customers. But where do we keep track of who owes us what? Well, we usually maintain a separate ledger called a subsidiary ledger. And that's where we keep track of specific details of each customer's individual account balance. The key is that when we add up all of those individual account balances in the subsidiary ledger, they have to equal the balance in the accounts receivable general ledger account. Now, there are also certain accounts we call permanent accounts. That doesn't mean they don't change. It means that they don't get affected by the closing process. Temporary accounts do. These are normally accounts that change retained earnings. Revenues, expenses, gains, losses, and dividends, if you have all of those types of accounts, are temporary accounts. We're only allowed to collect information in those accounts for 1 year. one accounting cycle. When that accounting cycle is complete, we need to reset them to 0 to prepare them for the next accounting year so we can collect information about revenues, expenses, gain, losses, and dividends for the next year. And we call that the closing process. So just some information. We're going to go through all these steps. So really quick, temporary accounts would not include accounts receivable. All the rest of these are temporary. Now, let's take a look at all the steps in the accounting process or cycle. So during the accounting period, so from the beginning through almost the whole year, okay, obtain information about external transactions from source documents. You'll analyze the transaction and record it as a journal entry. And then you will post each journal entry to the general ledger account it affected. Now, it says at the end of the accounting period, but I like to say this instead. When you're going to do a financial statement, most companies will do a financial statement once a month, okay, or every 3 months. They usually don't wait till the end of the accounting period. So if you want to change that to say, whenever I'm going to do a financial statement, this is the time we will make balances in each T account and prepare an unadjusted trial balance. Remember, a trial balance is a list of all the accounts with their balances. We will then also have to complete those adjusting entries, and we'll talk about those in more detail. We have to post those to the general ledger and update the T accounts for additional journal entries that result from this part of the process. And then we'll prepare another trial balance to make sure debits equal credits, the adjusted trial balance. And it is this trial balance that is used to prepare our financial statements. Now, at the very end of the year, this is when we reset or close the temporary accounts to retained earnings through journal entries, closing journal entries. Post those to the T accounts and prepare a post-closing trial balance. The only types of accounts that should be included on this trial balance are permanent accounts, assets, liabilities, paid in capital, and retained earnings. All the other accounts will have 0 balances. So let's go through the process. Steps 1 and 2. Well, we want to identify external transactions. So we obtain information from source documents. These source documents could be sales invoices to customers, bills we receive from suppliers, cash register tapes from cash sales. We want to make sure we know the date and the nature of the transaction, who was involved in it, and the monetary terms. Then step 2 is we analyze. This is where we look to see, okay, what was affected, how was it affected, and then ultimately record its effect within our accounting system. So let's take a look at our first transaction here. An attorney invested $50,000 to open a law office. Okay, so we're going to sit there and say, okay, usually you will have a chart of accounts in front of you, a list of all the different assets, liabilities, and parts of equity. We just don't have that in front of us. But from my experience, I know, okay, an attorney invested $50,000 to open a law office. So I know they gave cash of $50,000. And if this is a corporation, that means they received common stock. So the cash in the company increases. Cash is an asset. I should debit cash. Okay, now here they're showing it to you in the equation itself. Shareholders' equity will also increase. So we're taking this at a global level right now. What overall would happen to shareholders' equity? Not specific item in shareholders' equity. Well, it would increase also, and that means we would be crediting shareholders' equity. A $40,000 was borrowed from a bank and a note payable was signed. Again, cash would increase. Liabilities will increase. So if cash is increasing, it is an asset. Assets increase on the debit side. We're taking more of a loan out, so we owe more. So liabilities are increasing, specifically the notes payables liabilities increasing. Liabilities increase on the credit side. excuse me, supplies costing $3,000 were purchased on account. So they are not paying for them when they're purchased on account. That means the company owes the money. So the assets, supplies, will increase. Supplies then will be debited because assets are debited when they increase. Liabilities will also increase because they owe this money. So we're going to increase the liability accounts payable on the credit side. Another review, services were performed on account for $10,000. So on account means we didn't get any cash yet. Now the overall effect on our equation is assets increase because the amounts are owed to us. We keep track of amounts customers owe in accounts receivable. So we're going to debit accounts receivable because that asset is increasing. Shareholders' equity is increasing. Specifically, the revenue is because they performed a service. That's why this money is owed to them. So we're going to increase the revenue account. We do that on the credit side. Salaries of $5,000 were paid to employees. Here, the assets are decreasing by $5,000 because they paid cash. So cash asset is decreasing. Assets decrease on the credit side, so we'll credit cash. Shareholders' equity is also decreasing. Now, an expense, remember, decreases shareholders' equity. That's why you see it that way. But when we're looking at debiting and crediting, we want to know specifically the total amount of salaries expense. So during the year or time period, we always increase expenses on the debit side. So we accumulate all them. So we know how much in total it decreases shareholders' equity by. So please don't get confused by that. $500 of supplies were used. Well, here, now we're showing that we used up some of an asset, so we're going to decrease the asset supplies. And over in our T account, you can see then we're going to credit supplies $500. When we use up an asset, it becomes an expense, a cost of doing business. So we decrease shareholders' equity because expenses decrease shareholders' equity. And we'll record this as a debit to supplies expense. $1,000 was paid on account to the supplies vendor. So now we're paying cash. So our assets will decrease by $1,000 and the cash account credit $1,000. Liabilities are decreasing. When we pay this $1,000, we owe $1,000 less. So decrease liabilities by $1,000. When we record this in the T account, decreases to liabilities occur on the debit side. Okay, so that was practicing. I mean, in the real world, we don't really do step 2 with the accounting equation on paper, because actually on paper, we do it in our head. And for most of you, that's what you're doing. You're like, why are we going through this? I could do this in my head, but it's just taking us back to the beginning and making sure we see those connections. So let's record the transactions in a journal. Remember, a journal provides a chronological record of all the economic events, and they are recorded as a journal entry first. And after each transaction, your debits and credits must equal. There are special journals. I don't talk about them. We generally will use a general journal for all of our transactions. Each entry is expressed, like we said, in terms of equal debits and credits. So when we borrow $40,000 from the bank by signing a note payable, we know cash increased, and cash should increase on the debit side. So our journal entry will be cash debit $40,000 in the debit column. Notes payable liability, notice it's indented a little, and that's kind of a standing rule we have in accounting, that anytime you have a credit, you should indent the name of the account a little and then put a dollar amount in the credit column. Remember, we're crediting notes payable because the liability notes payable is increasing. We owe more money. So we want to put that in the credit column to indicate an increasing liability. Wow, look at all those. We're going to go through each one of these now and make sure we know how to complete a journal entry. Now, don't worry about taking a screenshot or anything of this. They'll be presented in each slide. So let's take a look. Two individuals on July 1st each invested $30,000 in a corporation. Each investor has issued 3,000 shares of common stock, was issued, I'm sorry. So the corporation gave the investors 3,000 shares of common stock. Each individual invested $3,000. So without any other information, we're going to increase our cash account. It's an asset. Assets increase on the debit side. And we're going to increase our stockholders' equity, paid-in capital account, common stock. Anytime the corporation sells stock for the first time, they will increase paid-in capital, in this case, common stock account, on the credit side for the total amount. The company borrowed $40,000 from a local bank and signed two notes. The first note for $10,000 requires payment of principal and 10% interest in 6 months. The second note for $30,000 requires the payment of principal in 2 years. Interest is calculated at 10% and is payable each year on July 1st, 2022 and July 1st, 2023. Wow, that's a lot of stuff, right? So what happened here? Well, the company borrowed $40,000. Debit cash. This is wrong. This journal entry is wrong. Ignore that. Common stock. Make sure you correct that. You don't get confused by it. They're not selling common stock here. They're borrowing money. So they want to increase notes payable, $40,000, the liability account. Now, if you want to do two separate notes payable accounts, that's fine. But make sure you credit the liability account notes payable. They paid $24,000 in advance for 1 year's rent on the store building. Now remember, whenever you prepay an expense, rent is an expense. An expense is a service the company has to pay for to operate their business. Usually, an expense occurs, so we receive the service, then we get the bill. But in a case where you didn't receive the service yet, you cannot call that item an expense. Not until it has occurred. So, as of today, we have an asset because the rent is owed to the company. So we debit the asset, prepaid rent, increase it on the debit side to show that amount is owed to the company. We decrease the asset cash because we paid cash out, and we do that on the credit side. That is the rule for an asset. Purchased office equipment from Etronics for $12,000 cash. What happened here? Bought office equipment, paid cash. So our office equipment asset is increasing, so we will debit that account. And our cash asset is decreasing, so we will credit it. Purchase $60,000 of clothing inventory on account from the Birdwell Wholesale Clothing Company. Now in this case, we're purchasing an asset inventory for $60,000. So we're definitely increasing the inventory T account or account. But we're not paying for it. We owe on that. So we have to increase the liability accounts payable. Liabilities increase on the credit side. So inventory will have a debit, accounts payable, a credit. Sorry, taking drinks of water. Okay, July 6th. Purchased $2,000 of supplies for cash. So what happened here? We bought an asset, supplies. So we have to increase the asset account supplies, $2,000. We paid for it with cash, so cash asset is decreasing on the credit side. During the month, on July 4th through the 31st, they sold merchandise costing $20,000 for $35,000 cash. Note, this entry reflects the perpetual inventory approach. Okay, so sold merchandise costing $20,000 for $35,000 cash. Now you got to think back to your inventory chapters back in Accounting 111. What happened here? The first thing is that they sold the inventory receiving $35,000 cash. So the cash increases. Why did they get cash? Because they sold inventory. So sales revenue increases by $35,000. So debit cash to increase the cash asset, $35,000. We're going to increase sales revenue, which always increases on the credit side. But there's another component of this journal entry. Now we have to decrease the inventory asset account for the cost of the inventory sold. We no longer own that inventory. We don't decrease it for what we sold it for. We decrease it for what we originally bought it for. And then we debit the expense account, cost of goods sold. Cost of goods sold is where we store the cost of anything that's been sold. And we make that journal entry the day it was sold. Sold clothing on account to Briarfield School for Girls for $3,500. The clothing cost $2,000. Again, we have two distinct journal entries here, one to record the sale and one to record the expensing of the inventory that was sold. Now this was on account, so Briarfield owes us $3,500. So we want to increase the asset accounts receivable. Remember, that's where we keep track of amounts customers owe us. And we want to increase sales revenue because that's why they owe us the money. We made a sale. We want to decrease the inventory asset account on the credit side and increase the expense account, cost of goods sold, for the cost of the items that were sold. Remember, cost of goods sold is an expense account. We're going to skip over the periodic inventory system right now. Let's go to our next one. Prepaid rent. Subleased a portion of the building to a jewelry store. So remember, we rented it. So we're the leaser or the leasee here. Well, what we did was we took the thing we're renting and rented it to someone else. So that's a sublease. A portion of the building to a jewelry store. Received $1,000 in advance for the first 2 months' rent beginning on July 16th. Well, we debit cash $1,000 because we got cash. Increase it. We don't decrease prepaid rent. We still, prepaid rent is prepaid rent. What we do is we increase the liability, deferred, and sometimes you hear it referred to as unearned rent revenue, because that is revenue to us. It's not earned yet because it was for advance. So as of today, when we get the money, we owe that service. So we increase the deferred rent revenue liability account on the credit side. Paid Birdwell Wholesale Clothing $25,000 on account. So remember, we owed them $25,000. We originally credited accounts payable for that $25,000. Now we're paying it off. So we'll debit accounts payable to decrease the liability because when we pay this, we no longer owe it. And we'll decrease cash, which is an asset. Assets are decreased on the credit side. Paid salaries to employees for the first half of the month, $5,000. Well, employees are people providing us a service to operate our business, so any payments to them are expenses. So we want to debit salaries expense, increase the expense account because we want to accumulate all the salary expense for the month. Do that on the debit side of the expense account. We want to decrease the cash account. We do that on the credit side because that's the rule for an asset. We're getting there. On July 25th, received $1,500 on account from Briarfield. So Briarfield, I think it was a girls' school or something, right? They owed us $1,500. They're paying us $1,500 cash. So we want to increase the cash account on the debit side. We're going to decrease the asset accounts receivable because it's going down. Briarfield no longer owes us that $1,500. Decrease assets on the credit side. The corporation paid its shareholders a cash dividend of $1,000. Now, if the company decides to keep track of dividend payments in a separate dividend account, we debit it each time the company pays more dividends. That's the side it increases on, and we want to accumulate all the dividends for a time period. In this case, they're paying cash as a dividend, so we want to decrease the cash account on the credit side. So just a quick check. After we recorded all those transactions and reviewed the rules of debits and credits, recording an expense for salaries incurred and paid in cash would be recorded by debiting an expense. The journal entry to record the issuance of common stock in exchange for cash involves a debit to cash and credits to a debit to cash and credit to common stock. And there it is. We already went over that, but just a nice review. All right, so that's the first big part, is recording journal entries for each external transaction. The next part is posting. And remember, don't get hung up on it. It's just transferring. It's transferring each journal entry dollars amount to the respective account in the general ledger. For instance, these are all the various journal entries, it looks like, from our journal entries we just did. These are all the postings of them, I should say. So in July 1, we debit prepaid rent. So in the general ledger, on the debit side, debits on the left, credits on the right, we will debit prepaid rent $24,000. On the credit side of the cash T account, we will put $24,000. And we will do that for each journal entry. So this PowerPoint presentation is separate in your Blackboard Learn account. So I encourage you to take each of those journal entries and do the tracing of the post from the journal entry to the general ledger T account that was affected by it, if you've never done that step. So the first slide we just looked at were the balance sheet accounts that were affected, and these are the income statements, but together they're the general ledger. And then you could see there's balances in each account. So if you've never learned the process of T accounts, you always have to find one balance in a T account. So what we do is we add up both sides separately in an account. So you'll add the debit side and the credit side. For instance, sales revenue. The debits are 0, the credits are $38,500. We then subtract the smaller side from the larger side. So it would be $38,500 minus 0. So the answer is $38,500. The balance, that is the balance, will go on the side that had the larger total, $38,500. For cost of goods sold, it would be a debit balance of $22,000. Once we've posted each journal entry to the T account affected and created a balance in each account, it's usually a time we're getting ready to do a financial statement. So we will create an unadjusted trial balance. Now, all an unadjusted trial balance is a listing of each T account, so the name of the T account and the balance of the account. And you just have to be careful that you put it, you're going to have a debit column and a credit column on a trial balance. You just want to make sure you put your debit or credit in the proper column. The purpose of this first trial balance is to make sure that at this time debits equal credits. So you have to add all the balances in the debit column and all the balances in the credit column, and they should equal. If they don't, you got to find out why. Because if debits don't equal credits, assets will never equal liabilities plus equity. It's just the way the rules are set up. All right, let's keep plowing. So there is an unadjusted trial balance for the company we're working on. So if you're going through it, and I strongly encourage you, create a journal. Create the T accounts. Post the journal entries into the T accounts. Come up with balances for each T account. And if you don't want to make an unadjusted trial balance, see if your balances agree. Because your T account balances should agree to this. And then you could see we make sure assets equal, or I'm sorry, debits equal credits. Now, we're not done, right? This is only the first step of the next step of the process, because at this point, we can't be sure all of our accounts are accurate. we want to make sure that any revenues and expenses that may be missing from the accounting period we're looking at are properly recorded. So this is where accrual accounting really comes into play. So remember, we want to ensure that all revenues are recognized in the period the good or service are transferred to the customer. So if there's any revenues that have been earned but aren't recorded yet, this is the time to do it. We make more journal entries. We also want to make sure any expenses that have occurred during the accounting period are properly recorded. Maybe most of them are, but we're not sure all of them are. So adjusting journal entries come out of us making sure that revenues and expenses, all of them, are properly recorded in this accounting period if they should be. Now there are some categories of adjusting journal entries. So most of the entries or items that are missing fall into one of 5 or 6 categories. And we're going to look at those now. So essentially, adjusting entries are usually the result of prepayment of expenses or customers paying us early on revenues. They may also be accruals, meaning there's something that happened, there's an expense that happened or a revenue that's happened that hasn't been recorded yet. And we'll look at those. And then finally, certain items that we estimate has to be done at some point during the year, and we usually wait till we're doing adjusting entries to complete any estimates. Some examples are calculating depreciation, estimating for bad debt expense, estimating for warranty expense. So let's look at prepayments first. This occurs when the cash precedes either the expense or the revenue recognition. What does this mean? Okay, remember before, we prepaid rent. We paid for it before we received the service. So when we recorded that payment, we didn't put it in rent expense, we recorded it in an asset called prepaid expenses. The other situation could be that we received the cash before we performed the service, like the subleasing to a company. We said, pay us $1,000 and you could lease off us some space over the next 2 months. Well, the day we got the cash, we didn't provide any service yet. So as of the day we received the cash, we had deferred revenue or unearned revenue. So what do we have to do? Well, at the end of the period, when it comes to a prepaid expense, we want to determine, did any of that prepayment actually occur by the end of the period we're looking at? And if it did, the part that has occurred, so the rent that has occurred, should be recorded as an expense by the end of the period we're reporting for. So typically you're going to debit an expense and credit the asset, the prepaid expense asset. For instance, Dress Right Clothing Corporation purchased 2,000 of supplies in July, and we debited supplies back then. So that's already done. Assume that Dress Right determines that at the end of July, $1,200 of the supplies remain. So when they bought the asset supplies, they debited supplies for $2,000. So right now, this T account, supplies, has a $2,000 balance in it. But at December 31st, according to the latest data they have about the supplies account, there's only $1,200. So they've used up $800 of that asset. So they have to decrease the supplies account for the $800 and increase the supplies expense for $800. When you use up an asset, it generally becomes an expense. So we're just transferring it from the asset category into its final resting place, the expense category. But only $800 of it, because that's the part that's been used up. So now the supplies account really reflects how much is left, and supplies expense really reflects what was used up. And that's the purpose of adjusting entries. So the assumption is when you're done with this entry, you post it immediately into the general ledger and update the balance. Here's our prepaid rent. Remember, at the beginning of July, Dress Right Clothing Corporation paid $24,000 to its landlord for 1 year's rent. On that day, they debited prepaid expense and credited cash. Well, as of July 31st, the end of the first month, 1 month's worth of that rent, or $2,000, $24,000 divided by 12 months, has become an expense. They've used up that part of the rent. So we decrease the asset prepaid rent. That's no longer owed to Dress Right. And we increase the rent expense because that's the portion of the prepayment that's been used up. Immediately posting that into the general ledger T accounts. Look at prepaid rent goes down $2,000. There's the credit being posted. Now the balance in prepaid rent is $22,000. That's how much is still owed to the company of rental time. Since we used up 1 month's worth of rent, it's properly accounted for because we debited rent expense in the T account rent expense. Here are some estimating. Office equipment was purchased during the month of July for $12 grand. Assume its useful life is 5 years. And it will be worthless at the end of that period. I think we're going to assume we're using straight line depreciation. If that's the case, we take the cost of the equipment, divide it by the life. Now you could do 5 years or 60 months. Since we need to determine 1 month's worth of depreciation expense here. Remember, they bought the office equipment the beginning of July, and only 1 month, it's July 31st. So we only need to expense 1 month's worth of that cost. So instead of just expensing that whole piece of equipment the day we buy it, no, our expense recognition says, no, call that an asset. And then as you use it, you could expense the cost of that. But remember that 60 months is an estimate. So we debit depreciation expense and we credit that contra asset account. Remember, contras have a buddy. In this case, accumulated depreciation's buddy would be office equipment. It's defining information about the office equipment, and its normal balance, the side it increases on, is opposite its buddy. So we would credit accumulated depreciation. So instead of crediting office equipment, which we just don't do, we decide to keep track of any amount we've expensed of the office equipment in this separate contra account. So the correct amount of prepaid insurance shown on a company's December 31st balance sheet was $1,400. On May 1, 2022, the company paid an additional insurance premium of $1,100. In the December 31st, 2022 balance sheet, the amount of prepaid expense was correctly shown as $1,000. How much is the insurance expense that should appear in the 2022 income statement? Well, the balance sheet starts at $1,400 in prepaid insurance. So that's the beginning balance, debit. They would have debited it for an additional $1,100. At the end of the year, the balance is at $1,000. So it would be $1,500. Beginning balance was $1,400. They increased prepaid insurance $1,100 during the year. If there's only $1,000 in the ending balance, there was an adjusting entry decreasing it. The asset account, prepaid insurance, $1,500, and it would have increased insurance expense $1,500. That's the amount of the insurance that was used up during the year. I'm going to bypass those. Let's go to this. Deferred revenues. Cash received from customers in advance of providing a good or service. So in this case, the customer paid us money. We didn't do anything for them yet. The day that they paid the money, we debited cash and credited a liability, deferred revenue. What happens during the adjusting process? Well, now we're asking ourselves, hey, between the day we got this payment and the end of the time period we're looking at, did we earn any of that revenue? Did we provide any of those services and products? If we did, that much of the deferred revenue liability account must be moved out of the liability by debiting it and into the revenue by crediting it, because now it should be recognized as a revenue. Example. Here's the sublease dress right made to a jewelry store for $500 a month. July 16th, they got $1,000 in advance for the first 2 months' rent. By the end of July, 1/2 of 1 month's rent service has been provided. So, $1,000 for 2 months, $500 for 1 month. 1/2 of 1 month would be $250. Should be recognized as rent revenue by DressRight. Debit the liability deferred rent revenue, decreasing at $250. That part has been earned by the company and is properly being shown now as rent revenue by increasing rent revenue on the credit side. And there's the T accounts. The day we received the cash, we credited deferred rent revenue. Since $250 of it has been earned by us, we debit deferred rent revenue. There's the posting of the $250. So now we still owe $750 in rental service to the jewelry store. And we're properly showing the $250 as rent revenue. The Contra Costa Times Company reported a $17,200 liability in its balance sheet for subscription revenue. So sometimes that happens, like a magazine. We pay for the magazine. Oh, excuse me. We pay for the magazine or the newspaper before we receive it. In this case, this company got $17,200 in advance. They owed that much as of the end of 2021 in services. They received another $68,000 from customers during the year for services to be rendered in the future, subscriptions for the future. And the 2022 income statement reported subscription revenue of $69,700. What is the liability amount for the deferred subscription revenue? All right. So in our deferred revenue liability account, it would have started with a credit balance of $17,200. It then would have increased by $68,000 during the year for those early payments we received. We recognized $69,700 as revenue. So that means the deferred revenue liability account would have been debited for $69,700. So you would have $17,200 plus $68,000 minus, your answer is $15,500. And we're going to skip over this. Accruals. That's our next type of adjusting entry. This is where cash flow occurs after either the expense or the revenue is recognized. So this is where an expense has occurred, hasn't been recorded yet, hasn't been paid. Well, just because it hasn't been recorded or hasn't been paid doesn't mean it's not an expense. Or a revenue, same situation. We performed the service, we didn't get paid, and we didn't record it yet. Well, we should get it recorded. We have revenue. It includes accrued liabilities and accrued receivables. So accrued liabilities would be related to expenses that have occurred but have not been recorded yet. Accrued receivables would be related to revenues that have occurred that have not been recorded yet. So let's take a look. These are liabilities are recorded when an expense has been occurred prior to paying for it. For example, well, before we do an example, the resulting journal entry will always be an increase in an expense and an increase in a liability. When it comes to an expense, when you're recording an expense, you're either going to credit cash because you paid for it, or you're going to credit a liability because you owe it. In these types of expense recognition, there's no cash involved in these transactions. Salaries is a perfect example. Take a look. July 20th, Dress Right Clothing Corporation paid its employees $5,000 for salaries for the first half of the month. Assume that salaries for the second half of July are $5,500. They weren't paid yet in July, but they'll be paid in early August. Well, we're trying to make financial statements as of July 31st. So the question is, do we have to record that $5,500 now as an expense or wait till it's paid in early August? You answer that by asking, when did the $5,500 occur? And when I say occur, I mean, when did the company receive the services? During July. So we're going to accrue the salaries. So we debit salaries expense, $5,500, and we credit a liability account, salaries payable, to show at July 31st, we have incurred an expense of $5,500 and we owe it. Now our salaries payable will properly represent the liability we owe, and that balance should be $5,500 down here, guys. And salaries expense properly reflects the total amount of salaries that occurred during July. Interest is another example. Remember, they took 2 loans out for a total of $40,000. Well, we want to figure out how much interest has occurred. Even though they don't owe the interest at the end of the month, interest is still occurring. Interest expense and interest revenue occur constantly, always. We just don't make a journal entry every second interest is happening. But when we make a financial statement, it's important to determine any type of interest, whether it be expense or revenue, that has occurred on anything, because it must be recorded. And in this case, we would take the $40,000 borrowed times the 10% interest rate times 10% is a 12-month interest rate for 12 months. So we want to know 1 month of 12. So the interest that's occurred on this note payable is $333. So we want to increase interest expense, $333, because that interest has happened. Since we're not paying it, we have to credit a liability interest payable to show if it was due, we would have had to pay $333 for the interest that occurred this month, July. So Gary's Grocery borrowed $12,000 and 8% interest on May 1st, 2021. The principal and interest are due in a year. The company's fiscal year ends December 31st. We need to make what amount of interest expense would appear in company's income statement for the year ended December 31st, 2021 related to this loan. Remember what we just said, interest is occurring beginning on May 1, 2021. So we don't say none because it's not paid until next year. No, we need to calculate the amount of interest from May 1st, 2021 through December 31st. That would have been calculated and recorded as an adjusting journal entry, $640. 12,000 times 8% times 8/12. Be careful. All of May, because the loan began May 1st. All of May, all of June, all of July, all of August, September, October, November, and December. So this company would have debited interest expense and credited interest payable, $640. Now, when it comes to accrued receivables, the item that wasn't recorded was revenue. So it's revenue that's earned but has not been recorded. Sorry about that little delay. So we are talking about increasing revenues from this adjusting journal entry, finding that revenue that has not been recorded yet, and increasing an asset such as accounts receivable, or if you keep a special account for accrued revenue as an asset. Here's an example. Assume Dress-Right loaned another corporation $30,000 at the beginning of August. Terms of the note call for the payment of principal of $30,000 and interest at 8% in 3 months. Well, as of the end of August, if we're looking at that date, 30,000 times 8% times 1/12 of the interest has been earned or accrued. So on August 31st, we would increase the revenue, interest revenue, because we earned that revenue, even though it's not due or it hasn't been paid yet. And because it hasn't been paid yet by the debtor, we would increase an interest receivable to show that part of the interest revenue is owed to us. Estimating. Now, the third classification of adjusting entries is just that. Depreciation is an estimate because we use expected useful life, which is an estimate by the company, and expected residual value. Bad debt expense is another example of an adjusting entry that's considered an estimate. So remember, and we're going to review this again, but if you're like kind of rusty on bad debt expense, the accounting rules we use require us to estimate based on current year information, how much of the current year accounts receivables probably won't be collected in the future. We're estimating that, and we're recording it as bad debt expense now. We're not waiting till the accounts actually become bad to call them bad debt expense. So those are just two examples of estimating. Once we complete the adjusting entries, we post them to their respective T accounts, just like any other journal entry. And it's at that point, I back up a second. After we post each of those adjusting journal entries into the respective T account, we find a new balance or adjusted balance in each account and create an adjusted trial balance. So you can see the difference between these two trial balances for DressRight. The unadjusted trial balance, debits equal credits, but the adjusted trial balance, debits equal credits, but look at all the items that were missing or wrong on the unadjusted trial balance. There was no interest expense. No, we found that during the adjusting journal entry process. There was no depreciation expense. Again, same deal. Same with rent expense. So if we don't go through the process of asking ourselves, are all the expenses that have actually happened recorded, and find missing ones and get them recorded, or if we don't look and find missing revenues, our dollar amounts will not show a true picture of our financial activity. That's why it leads us to the adjusted trial balance. And it's that trial balance that's used to complete the financial statements. So that's our next step. So this is our primary means of communicating our financial information to external parties, and they're very formal. There's an income statement, a statement of comprehensive income, a balance sheet, statement of cash flows, and statement of shareholders' equity. Remember, on the income statement, we're showing a change statement that reports the change in retained earnings as a result of revenues, expenses, gains, and losses. So it's only those 4 items within retained earnings that are reported on the income statement. So here is DressRight Clothing Corporation's. Write off their adjusted trial balance. Sales revenue, $38,500. Cost of goods sold, remember, is an expense. We subtract it to get gross profit. We then list our major operating expenses, expenses directly related to the operations of our business. Salaries expense, supplies, rent expense, depreciation expense. We total those up. These are all off the adjusted trial balance again. Subtract those expenses from the gross profit to get operating income. That's income purely from our operating activities. If there's any other revenues, expenses, gains, or losses, we report them in the other income and expense. Rent revenue is not an operating revenue because our direct operations is selling clothes, not renting, so we list it as other. Interest expense is an expense as a result of financing the company. Has nothing to do with direct operations, so it's always listed as an other income or expense. We net the revenue and the expense together. Overall, the expense was greater, so we will decrease our operating income by that $83 to get to net income. So that's a general format for our income statement. We call it a multiple step. We have a whole chapter on the income statement. So we'll be revisiting this again, but it's just to get us back into the groove of the financial statements. The statement of comprehensive income you may or may not have completed in Accounting 112. It is a newer statement, and sometimes it's not separate. It's part of the regular income statement. And a company has a choice how they would like to present it. Comprehensive income reports all changes to equity that are not related to the shareholders. They're not transactions with the owners. So the buying of stock or treasury stock and selling of treasury stock or regular stock, common stock, preferred stock, and the payment of dividends are ignored. This statement always starts with net income. Net income is income. But there may be other things that are not allowed on the income statement that are considered gains and losses. And when we record them, we kind of bypass the income statement and we put them directly into shareholders' equity. One such item is unrealized gains or losses on available for sale bonds. Wow, that was a lot of stuff, right? So when you did work on investments, Chapter 12, I think it was, in Accounting 112, at the end of the year when it came to a bond, if it was in the category of available for sale, and all that meant was the company's intention was to not sell the bond really quick, but not hold it to maturity. Kind of fell in between two extremes. Any artificial gain or loss because the value of the bond went up or down by the end of the year was recorded as an unrealized gain or loss. Most of these types of artificial gains and losses are reported on the income statement, but this is one that is not. It's never included in net income. However, it is included in the statement of comprehensive income. So there it is telling you can make it one big statement or you can make two separate statements. So we don't even have it here because they didn't have any special items that would have changed net income and comprehensive income are the same amount. And they're very unique items. And for most of them, you won't see them till you're in Intermediate Accounting 3. The next financial statement is the balance sheet. Remember, this is where we report the assets, liabilities, and stockholders' equity at a point in time. So this point in time would be August 31st. We do complete a classified balance sheet. Remember that? Where we have various subgroups of assets and liabilities. Current assets versus long-term. Current liabilities versus long-term. Current assets, cash, will be converted into cash or will be used up within 1 year or operating cycle. So those are the characteristics associated with an asset that should be in this category. Current liabilities are liabilities that will be paid off or are due within the coming year from the date of the balance sheet. So you're like, what year? The date of the balance sheet. So if your date of the balance sheet is August 31st, 2019, you're looking forward to August 31st, 2020. What assets will be used up, converted into cash by the end of August 31st, 2020? Same with liabilities. Non-current assets have even more subcategories. Property and equipment. So these are tangible assets that are used in the business more than a year. Equipment, land, buildings. Long-term receivables and long-term investments. Long-term investments are generally assets that you own, the company owns, but do not use in operations. They kind of are just sitting there appreciating. Maybe stock of another company or a piece of land that the company isn't using in its business, it just owns it. Also, intangible assets is another category of long-term assets or non-current. These are assets that don't have physical form, but are used in the business to provide revenue, copyrights, trademarks, patents. Long-term liabilities are all liabilities not classified as current. They're due beyond the coming year. And then, of course, shareholders' equity, and is split up between the two distinct subcategories within stockholders' equity, paid-in capital and retained earnings. So there is Dress Right Clothing's classified balance sheet. Notice the date, July, well, that should be, they're using July 31st, I guess, July 31st, 2021. Notice the current assets. We always list current assets in liquidity order, financial liquidity order. The quicker an asset can be converted to cash, the higher in liquidity it is. So cash is always first. And then unless we have short-term investments, accounts receivables are next. Supplies, inventory, and prepaid rent pretty much have the same kind of standing on the liquidity scale. So it doesn't really matter what order they're in. But all those assets will be used up or collected within the coming year. We total them up. The only long-term asset Dress Right has is property and equipment. It has office equipment. So we'll list the office equipment. Remember, when there's a contra account, you must subtract the balance of the contra account from its buddy. So less accumulated depreciation. So far, this company has expensed $200 of the $12,000 they paid for the office equipment. We report the net, or what we call book value, of the office equipment as the final amount on the balance sheet, $11,800. Add the total current assets to the $11,800. Total assets, notice we double underline. Next, we have liabilities and shareholders' equity. All the liabilities except for the one note payable, the one that is due, I think it was 2 years, are current liabilities. Most liabilities will be current. Accounts payable, salaries payable, these are right off the adjusted trial balance. Deferred rent revenue, interest payable, and notes payable. These are all liabilities that are due or will be paid in the coming year. Total of $51,583. The note payable that's due beyond July 31st, 2022 is listed as a long-term liability, $30,000. Now, sometimes companies will total the liabilities, and you can there if you wanted to. This company chose not to. The final section is shareholders' equity. The first thing you will report is paid-in capital. And this company's only paid-in capital was common stock. Remember, they sold 6,000 shares and received $60,000. And that's the balance of common stock. Retained earnings, the balance is $1,917. How do we get that? Well, retained earnings started at zero because this is the first time the company even opened. They had a $2,917 profit. So net income increases retained earnings. And then they paid out dividends of $1,000. Dividends decrease retained earnings. So the balance of retained earnings is $1,917. Add those two together to get your total shareholders' equity. Add your current liabilities, long-term liabilities, and total shareholders' equity to get total liabilities and shareholders' equity. And we know assets must always equal liabilities plus equity. The statement of cash flow, which I'm going to go through, but talk about it a little bit, but we're not going to focus on a lot in this chapter. As we know from Accounting 112, the statement of cash flows gives us information about how we spend our money. The three major categories that we report about how we spend the money in the company is operating activities. So here we're reporting all the cash inflows and outflows from us operating, purely operating. So these are transactions entering into the determination of net income. Remember, net income is not net cash flow. Net income is an accrual number. It has non-cash items in it. So in this part of the statement of cash flows, we are trying to figure out how much cash is provided by operations. Then there's the investing activities. Now, when you hear the word investing, you think those are things I'm buying. I'm putting my money into, I own now. And that's true for a business as well. These are primarily long-term assets. So here's where we're reporting the inflows and outflows of cash from long-term assets and non-operating investment assets. So whenever you buy new equipment or buildings or intangible assets or investments, you're going to report the effect on cash flow here. The same with when you sell those. And then there's financing activities. And this is the cash inflows and outflows from transactions with long-term liabilities, so notes payables usually, and any kind of stockholder equity activity that involves cash. They are reported in the financing area of the statement of cash flow. So here's dress rights. Okay. Now, like I said, we're not going to go through how we did all of this, but this is how they would have completed the direct method of the statement of cash flow. So when the company completed their statement of cash flow, the net cash flow from operating activities was negative. They actually spent more in their operations than they brought in for that month. They purchased equipment, so they spent money in the investing area. But they sold common stock, so they received cash. They borrowed money from the bank of $40,000, so that was cash from coming in from financing activities, and they paid a dividend, which decreases financing activity cash flow because they paid it. So overall, financing activities brought in $99,000 of cash to the business. The cash increased then, if you net together cash flow from operating, investing, and financing activities, that will tell you how much cash increased or decreased for that period of time. The final financial statement is the statement of shareholders or stockholders' equity. This shows how shareholders' equity changed due to investment by owners, distribution to owners, net income, and other comprehensive income. So you might have heard of a statement of retained earnings in Accounting 112. The statement of retained earnings is part of the statement of shareholders' equity. Statement of shareholders' equity is all of shareholders' equity, where it started, what changed it, and where it ended by major types of categories. Here are the major categories and the statement of shareholders' equity for DressRight. They have two major shareholder equity accounts, common stock and retained earnings. If they had more, there would be columns for them. So we always start, just like any owner's equity statement, balance at the beginning of the month or the time period. So this company wasn't in existence, so it's zero. Now, how did common stock change during the year? Well, they sold more. So we'll show issue of common stock in the $60,000 in the common stock column. And that was the only change. How did retained earnings change? Well, there was net income for July, so we will show that as positive, but the company paid dividends, so it decreased retained earnings. So we labeled them as such, net those two together. So the final balance at July 31st should agree to the amount on your adjusted trial balance. Common stock is 60, retained earnings 1917. The final column just takes those amounts all together. So total shareholders' equity, $61,917. So once we're done with those financial statements, now, and it's the end of the year, now we can get ready for the next accounting year, and that is the closing process. So it reduces our temporary accounts to zero, the closing process, and it transfers their balances to retained earnings. Okay, remember, and I can't go backwards in my slide presentation, but remember, on our shareholder equity statement, we said, oh, the balance in retained earnings is $1,917. But if you looked in your T accounts, there isn't even a retained earnings account yet. That will be created during the closing process. So by the time we're finished with this year, there will be a retained earnings statement with a balance of $1,917. So to achieve this process, we have to do more journal entries. Just like Any other time we want to change a T account balance, you must start with the journal entry. So we're going to, using the adjusted trial balance, we will prepare the entry to close revenues to retained earnings. Remember, sales revenue and rent revenue both have credit balances. We need their balance to be zero, so we must debit those accounts for the entire balance during the closing process and credit retained earnings for the total. So we just transferred the revenues out of the revenue accounts and into retained earnings. During the year, we keep track of these items separately, so it's easy to make financial statements. But at the end of the year, once our financial statements are done, put the revenue where it should have been the whole time, retained earnings. We do the same thing with expenses. Since all of our expenses have debit balances, to reset them to zero, we need to credit them, each one, for their entire balance for the year. Add up all those credits and we debit retained earnings. Again, transferring the amount out of the individual expense account into retained earnings. Because retained earnings in this example began with zero, after we add the credits and subtract the debits, the retained earnings account equals net income. And it should, because that's what's in there right now. So there's the posting. Now we could have showed you all the T accounts for revenues and expenses. They would have been zero after you posted the two closing journal entries we just completed. And you should go through that process. But in retained earnings, you have to create a retained earnings account, credit it for the revenues, debit it for the expense amount. There's net income. But we have one final thing. The dividends. Since we kept track of dividends in its own account, we have to reset that to zero as well. If you think back to Accounting 111, it was kind of like the withdrawals account. Okay, so we need to credit dividends because it currently has a debit balance, and then debit retained earnings. Whoops. And once we do that, retained earnings will have a balance of $1,917 and the dividends will be zero. Now, the dividends will be zero balance, revenues will be zero balance, and expenses will be zero balance. So the only accounts that will have balances are those ones that are considered permanent or don't change during closing journal entry process. The assets, the liabilities, and the two major parts of stockholders' equity, common stock, and retained earnings. So the cash, accounts receivable, supplies, all these asset balances are the same as they were when we made the balance sheet because no journal entries were done to change them. Same with the liabilities. The only account that will change that's permanent during this process is retained earnings because we're updating it. The major purpose of doing this final post-closing trial balance is just to make sure that we closed all the accounts out that needed to be done, we posted all of them, and our debits equal credits at the end of the accounting period. And once we finish this post-closing trial balance, we're ready to start the next accounting year. So that ends the major points of Chapter 2 I wanted to discuss. There is more information about reversing entries, converting from accrual to cash basis, accounting worksheets, and some other miscellaneous items that I encourage you to read through and ask questions on. But I wanted to make sure you understand that whole accounting cycle. Again, you start by analyzing external transactions, create journal entries, post them to the general ledger T accounts, and when you're getting ready to do a financial statement, create an unadjusted trial balance. Now you're looking for missing revenues and expenses and recording them as adjusting journal entries. Posting those to your T accounts and updating the balances. Now creating an adjusted trial balance. It's the adjusted trial balance we use to complete the financial statements. And if it's the end of the year, you need to get ready for the next accounting year by resetting all of your temporary accounts to zero and getting them ready through closing journal entries, updating your retained earnings balance, posting those to the T accounts, making sure that they all accomplish what they were supposed to, and completing a post-closing trial balance. Okay, so that concludes our discussion. Please post questions to the discussion board.